All right, thank you all for being here, bright and early, 7 p.m. sharp. And today is our second part of Options for Beginners. It's a two-part fundamental guide, everything you need to know to get started with options trading. As we covered in part one, options are a type of investment contract that gives one the right but not the obligation to buy or sell a security at a specific price by a certain date. This can seem complex, especially if you are new to options, but we'll break it down for you step-by-step guide in this two-part webinar series. And thank you all for being here and to enhance your understanding of options trading. What will we cover today? We're going through unpacking options, the types, styles, moneyness, and Greeks. This will all make sense to you very, very shortly. We're going to cover understanding options pricing as well, and you will have an introduction to volatility, historical volatility, and implied volatility, basic options trading strategies, as well as risk management considerations when you trade options. Let me introduce our speakers for today. We have Srinidhi Raghavendra, who's the founder and CEO of Min Finance. Sri brings over 20 years of capital markets experience covering equities, listed derivatives, OTC commodity derivatives, and digital assets. Sri has straddled sell side and buy side of the industry with more than 10 years of experience at the Singapore Exchange. And Sri is the founder, CEO of Singapore-based Min Finance. And prior to the current role, Sri was VP at the Singapore Exchange, where he managed listed products, OTC derivatives, and OTC trade registration platforms. And with him today, we have Pranay Yadav. He's the Senior Research Analyst for Min Finance. Pranay is a Senior Research Analyst, and he has deep expertise in global macro, focusing on agriculture, metals, oil, rates, FX, and digital assets. His top-down research methodology enables identification of key global macro trends across different asset classes. And combining macro trends with bottom-up commodity-centric fundamental factors helps him produce comprehensive and sound actionable research, which you'll have a taste of when he comes on to share points 2 to 4 later today. All right, so that's the outline for today, and just a quick check. If you can go to your chat box, which you can see in your control panel, just type yes if you can hear me loud and clear, just before I hand the reins over to our keynote speakers for today.
Thanks, Sri. Sri, am I loud and clear to you?
You are loud and clear. All right, Sri, we are all set to hand the time over to you. If you're all set to go, the floor is yours.
Excellent. Thanks so much, Sri. Sri, at any point in time, because I'm only looking at one screen, if there are questions, if any, feel free to interrupt me. Happy to clarify those along the way.
Sure,
And also,
sure.
if there
We'll
are
keep
any
you posted.
hiccups, yes, please. Thank you so much. All right. Good evening, everyone. Thank you so much. So this is part two of the Options for Beginners, a two-part fundamental guide. Thanks for the kind introduction, Sri. So for today's session, as Sri mentioned, so we will be, again, just to quickly recap, right? 2 weeks ago on 9th July, we did a quick introduction to derivatives. We kind of had an overview of equity index options. We looked at the benefits of options and its use cases. We looked at risks that are very intrinsic or idiosyncratic to trading options themselves. And we also had an overview on the construction of options payoff charts. Building off from that foundational set of lessons, what we'll be covering today is to look at options a bit more in detail. Again, it's not easy, right? It takes a while. Although the concepts are not fundamentally hard, they're not necessarily intuitive. So it takes a while before one can grasp their head around how these different products work. So that's what we'll try and attempt to do today. Then part two of today's session, we'll look at options pricing. This again is a very deep science. We could be spending weeks on just looking at options pricing, but what we will do today is to show you tools that you can use to compute theoretical pricing and make sense of that from a market perspective as well. Options are all about volatility. So no volatility, no options, essentially. So section 3 of today's webinar, we want to spend some time on volatility. There are different types of volatility. Here again, so Pranay will go make a bit of a deep dive, if you will, looking at different aspects to volatility. Then in section 4, we look at basic options trading strategies. Section 5, which is what we'll conclude the webinar with, is our risk management considerations when trading options. All right, without further ado, so we move. So again, for those of you who may not have joined the last time, a quick introduction to what we do as a company. So our business is, set across three pillars, if you will: consulting, research, and education. In research, we write about AI, we talk about energy transition, and we write about changing world order. On any given week, we are publishing easily a dozen research notes. In consulting, we have three different practices. We have a risk management practice, we have a capital markets practice, we have a practice that is starting to look at portfolio construction for our clients. Then in terms of education, we run bespoke workshops much like this. We also conduct events called Navigating Global Macro. We look at broadly what's happening in the world and how what that means to different asset classes and security prices. And we're also in the process of getting started with demystifying markets. So this would be a monthly webinar, if you will. We're covering what's happening in the marketplace and how investors should be looking at their portfolios in that context. All right. So as with any educational workshops in this domain, we wish to highlight, emphasize that this is for general education, and whatever materials that we circulate are for pure circulation purposes only. This is not an investment or a risk management workshop. We are not necessarily addressing any specific investment or risk management objective or financial situation. So we strongly encourage you, A, to do your own research, one, and two, to seek financial advice from a registered financial advisor before embarking on any investment initiative. Also take note, past results are not indicative of future performance. Examples will be used in this webinar, and these are hypothetical, and these are used for explanation purposes only. This may or may not be the results of actual market experience. So with that, I wish to continue. Please keep in mind, because we are living in a world wherein there are a lot of whole YouTube videos that talk about how to invest and become millionaires overnight, and there are a lot of pitfalls in those. Regulators globally are amping up the level of scrutiny around these, and which is why we are very clear that what we are doing is pure education and not investment advice. So with that, let's proceed. So starting with section 1 of this webinar today, unpacking options in detail. A quick recap. What are options? Again, as we mentioned before, right? So options are like, it's a contract. It's a contract between two parties. They're no different from any other contract, just that these are standardized contracts. So these are financial derivatives that allow traders to speculate on or hedge against the volatility of an underlying asset. So that's what makes it very, very specific and very standardized. Option contracts can be of two types. It could either be a call or it could be a put. A call option contract gives the holder of the contract the right to buy, while the put contract gives the right to sell an asset at a specified price at a future point in time. So those are the two types of contracts. Standardized contracts, two types: calls and puts. Moving on, there'll be two parties. Again, like with most contracts, two parties to a contract. One party acquires the right. So he or she is referred to as an option buyer or an option holder. And the other party takes on the obligation. The party taking on the obligation is the option seller. As you all can appreciate, there are no free lunches in this world, and financial markets more so. Because the buyer is securing a right, he or she has to part with something to be able to secure that right. And what is it? It's cash, essentially cash going from the buyer to the seller. And what is that cash? It is the premium. It is the option price. So the option price and the option premium are the same things. So because the buyer secures a right from the seller, and because the seller takes on the obligation for the buyer, the seller secures option price at the beginning. He collects the option price. For those of you who may have traded futures contracts, I want to draw a distinction here, right? Whether you're a buyer to a futures contract or a seller to a futures contract, you have to pay margins. But in the case of options, it's different. How? Because the buyer pays options premium upfront, the buyer is not required to post any more margins thereafter. So therefore, to that extent, it's almost zero headache thereafter, right? But for the seller, it's different. He has collected the options premium upfront, but as the markets move, his short position on the option, because he has sold an option, those are marked to market on a daily basis. He or she is exposed to margin calls depending on how the prices move. So they must post margins with the clearing house through the clearing member like Phillip Nova. Finally, insofar as the buyer is concerned, the holder is concerned, it's hassle-free. Having paid the premium, they don't have to worry about anything else, as I mentioned earlier. So the option holders or buyers are not required to post additional margin once the premium has been paid. Moving on, so fleshing out a bit more of types of options, right? Calls and puts. So let's start with call options. As I mentioned earlier, call options are essentially a contract that gives the holder the right to buy an asset at a particular price at any point in time in the future that's defined by the term of the contract. So why would investors buy a call option, for example? So investors buy calls when they expect underlying prices to rise. If you see, for example, if I were to bring an example of an equity option, NVIDIA options, NVIDIA prices have been skyrocketing all the way from what it used to be like a $40 per share contract to what it is now. It's been skyrocketing. A lot of participants, I mean, this is after stock split, right? Before stock split, the contract was $400, $1,000. A lot of people cannot afford. So the affordable way of participating is to buy a call option because the premium is a lot lower. And why would they buy? Because they expect NVIDIA prices to keep rising. And when it rises, the value of the call option contract increases. And that's how they stand to gain. So that's when investors buy calls, and it gives the holder the option to buy the underlying asset at a future point in time at a strike price. As you can see the payoff chart, so that's the payoff for a call option, which allows the holder to buy at strike point A. So let's say, I'm making this example now, right? Let's say the contract today, the value of NVIDIA before stock split, it's $400. You buy an option contract, call option at $600 strike price. And when this underlying price of NVIDIA rises to, let's say, 900, the 600 call is very, very rich. It's very valuable. The premium that one would have paid when it was 400, when the underlying price was 400, would be minuscule compared to the value of the contract when NVIDIA shares are trading at $900. So that's why people buy call options. So think of it this way, right? Calls and buy go together. Calls give the holder the right to buy the underlying asset. In contrast, put options are different. And why would someone deal with put options? Investors buy put options when they expect the underlying prices to fall. Frankly, the most valuable use of options contract is in this. When you have a portfolio of assets, when you have shares or whatever the portfolio may comprise of, if there are option contracts around those, using options to protect against prices downward movement when you expect markets to be volatile. Think US elections, think FOMC decisions, think of non-farm payrolls. All these can have big impact on share prices or even earnings for that matter. We're going through earnings season. All these can create scenarios where the prices of stocks can drop quite sharply. In those situations, put options are very, very valuable. So investors buy puts when they expect underlying prices to fall. So puts, this gives the holder the option to sell the underlying asset. So think of these in pairs, right? Calls, buy, puts, sell. As you can see the payoff chart, so when the underlying prices fall, the holder of the put option gets to sell at strike A. Think of it this way, right? So this let's say point A is $80. So the share price drops to 60. Here is a option holder who can sell his asset at $80 even though the underlying price has fallen to $60. So he doesn't have to worry once the share price falls below $80 because he has protection. So that's what put options offer. In fact, put options, when you hold a put option, they're typically referred to as protective puts. Shri, any further questions at this juncture, or are we good to go?
We're good for now.
Okay, thank you. Moving on to expiry types. Again, options are unique in that they have different types of expiry. So as I mentioned earlier, and as we covered previously, options have a term. So it could be a 3-month option, could be a 1-day option, it could be a 1-year option. But the reality of life is that the time to expiry keeps diminishing. So let's say I bought a 1-week option 3 days ago. I only have 4 more days to go. By end of day tomorrow, I'll only have 3 more days to go, which is what makes the option a wasting asset. This expiry, this time to expiry of 1 week, also behaves in different ways. There are many, many different types of expiry. Most popular or most common ones are 2 of them. European options American options. Interestingly, they do not have anything to do with the geography itself. It has nothing to do with Europe or with America for that matter. Let's start with European options, right? European options can be exercised only at options expiry date. Only at expiry is when you can exercise a European option. There was a question that was asked last week, and I want to clarify it again. We clarified last week, 2 weeks ago. I wish to clarify it again. Just because the European option can be exercised only at expiry, nothing stops you, the trader, from selling an option that you're already holding. Let's say it was a European option that I bought 3 days ago for 1 week expiry. I could buy on day one and sell that European option on day three. Nothing stops me. What it stops me from doing is the ability to exercise that option before the expiry date. I can only exercise this option on the seventh day when the option actual expiry date occurs. All else being equal, European options are cheaper related to an identical American option. What are American options on that note? American options, in distinction to European options, can be exercised at any time from inception to expiry. Let's go back to my example, right? My option was for 1 week. I bought it 3 days ago. If I choose to exercise this option today, I can because it's an American option. I'm holding an American option. I can exercise it now if I wanted to because the contract inherently gives me the flexibility to exercise anytime from the moment I buy until the expiry of the option. So it gives me more flexibility and more latitude. Again, as I mentioned earlier, American options are expensive related to an identical European option. And you can imagine why. If as a holder, if I have more flexibility, no free lunches again, that extra flexibility comes at a price. And therefore that is built into the premium. So the premiums for an American option is more expensive compared to an identical European option. American options also can be bought and sold any number of times before expiry. The fact that you can exercise it anytime in between doesn't prohibit or inhibit your ability to trade, to buy and sell anytime in between. Moving on. So the reason I'm flashing this slide, we flashed this last 2 weeks ago as well. As you can notice, for CME on the S&P 500 options and also the NASDAQ micro options, you have both American and European types. Again, to go back to the point that I made earlier, right? This has nothing to do with geography. CME, it's a US exchange. They have American options. On the quarterly options, they're American expiry style. And their monthly options and the weekly options have a European expiry style. So it is the nature of the contract. As a participant in the marketplace, what's important for you is to understand what type of option this is. Before you buy or sell, it's important to understand what is it that you're buying or selling. And it's crucial to understand, are you trading an American or a European option? Especially with an American option, as a seller of an option, the risk of getting assigned on an option is very high, and that can have consequence in terms of the capital that you set aside for trading options. So that's where it becomes all the more important. Moving on to moneyness of an option. So this is another dimension, right, to an option contract. What is moneyness? So let's kind of flesh it out, right? So typically there are three types of moneyness to an option. One is out of the money. So typically what you generally see that gets traded in the marketplace are out of the money options. We'll come to it in a second as to what is an out of the money option. Then there are ATMs, at the money option, and there are in the money options. So essentially it's a state of an option. If you kind of stretch it a bit more further out, if an option is really far, the underlying price, let's go back to the example I gave you earlier, right, on NVIDIA. The strike price of the option was $600 before stock split, that is. Let's say NVIDIA share prices rallied all the way to about $1,400 before the stock split. At $1,400 is the underlying price, $600 is the strike price. This option is typically referred to as deep in the money option. It's not only in the money, it's deeply in the money. By the same token, let's think of another underlying, let's say, right? The underlying was, the strike price was at 60. The stock is currently trading at $6. It is not only out of the money, it's deep out of the money. That's where the fourth and the fifth states also come into play. So the underlying price and strike price are the ones that determines the moneyness of an option. Also keep in mind, right, moneyness of an option is defined from a holder's perspective. When someone tells you that this is deep in the money option, it is deep in the money for the buyer, for the holder of the option. By the same token, it's deep out of the money, so to speak, from a seller's perspective. So when you typically refer to in the news or in whatever journals that you might read, moneyness of an option is defined from a holder's perspective. Options moneyness is not constant. It keeps changing all the time. As the underlying prices change, option moneyness changes. It's not unthinkable that in the morning it was out of the money, in the afternoon it was in the money, by evening it was out of the money again. It's possible. It may happen. So what exactly is moneyness, right? So let's take an example now. So I'm using an example of the micro E-mini S&P 500 options listed on the CME, right? So let's think of the first example now, a long 6,000 call. So you as a trader, you have bought an option with a strike price of 6,000. So a long call, what would that look like? A long call would essentially look like this, right? The green line. So this option, you have bought it when it was out of the money, let's say, right? When S&P was trading at 5,800. So this option will become in the money when? Only when it crosses 6,100. The reason it's 6,100 is because I'm assuming that what is baked into this example is 100 index points for as options premium. So the S&P option strike price is 6,000, premium is 100 index points. The S&P index has to cross at least 6,100 before this option becomes in the money for you. So if you're holding this option, think of it this way, right? Only when you're above the red line, which is the option payoff, is this option positive for you. In fact, the textbook definition of moneyness is this. If it's at the money option, if you were to exercise the option now, the cash flow you get from exercising the option and the premiums that you have paid for the option, the net cash flow should be zero, inclusive of transaction costs. Then it's referred to as at the money option. If that number is positive, I'll repeat myself again, right? If you were to exercise the option now, the cash flow you receive from this option, net of the cash flow that you have paid for this option, if it's positive, it's in the money. If you exercise now, the cash flow you receive and the cash flow that you have paid for on a net basis, if you're negative, then it's out of the money. So that's the textbook definition. For most practical purposes, if you're above the red line, if you have a positive payoff, the option is in the money. If you're on the red line, it's at the money. If you're below the red line, you're out of the money. So for this long 6,000 call on CME, E-mini, micro, S&P 500 options, if it's above 6,100, you're in the money. Below 6,100, you're out of the money. At 6,100, you are at the money. Sorry, below 6,100, it's out of the money. But the same token, the payoff for a long 6,000 put would be represented by the orange line. Here again, right? It's a put option, by the way. So this makes money when the underlying market falls or loses value. So the index drops from 6,000 to 5,500. As you can see, the option is paying off $2,000. Is that in the money? Yes, at that juncture, it is in the money. At 5,900, is it in the money? No, it isn't, because your cash flow at that level is zero. So it's at the money. Above 5,900, you would be losing $500. So at that level, it is out of the money. So for a put option, again, same principles. Above the red line, you're in the money. On the red line, you're at the money. Below the red line, it's out of the money. So I hope it makes sense. So a given option on its own, it's only relative to the underlying that you can determine if it's in the money or not. So as I mentioned earlier, so the underlying price versus the strike price, the distance between the two determines, and given the nature of the option, if it's a call or a put, determines if the option is in the money, out of the money, or at the money. I hope that clarifies. So that will take us to the second section, which is Introduction to Options Volatility. Pranay, you want to take over from me?
Yeah, Sri, thank you. I'll just share my
Thank you.
screen.
Thank you.
Hope this is visible and I'm coming through loud and clear.
Yes, you are. Thanks.
Okay, so the few things I'll be covering today, right? Options volatility, leading into how to price options, or rather for us, what options are priced using. And then finally, some basic options trading strategy. And finally, I'll hand over to Sri for some risk management considerations when trading options. So starting with volatility, right? What exactly is volatility? We'll start with the basics. So volatility represents the fluctuation in the price of an asset. It represents how much an asset moves up and down. So the asset might move up and down a lot, in which case it would be a high volatility asset, or an asset might move up and down a little, in which case it would be lower volatility. If you wanted to formalize this concept when talking about finance, we use the term called historical volatility. So this is a term that's used to represent the standard deviation of an asset's returns rather, over a given period. So when we take, say, the returns of the S&P 500 over the past 10 days, the standard deviation of those returns, that will essentially be the historical volatility of the asset. So another small sort of technicality here, right? When we generally talk about volatility, especially historical volatility, we generally represent it in an annualized format. So that means the volatility value is scaled up to what it represents over an entire year of trading. So standard deviation of the asset's return over the past 10 days, and then we take whatever that calculation comes up to, and then we multiply it by how many days we would be trading this option for in a year. If we kind of want to simplify things a little bit, walking away from technicality, we can use the slightly more simplistic definition, which shows us that volatility can be used to understand how much a price is deviating from its average trend. So here, if I was to bring up this image, right, both of these assets, the blue line and the green line, no specific asset in particular, but both of them are trending upward. They're both rising. Both of them are also falling and rising around this trend line. But as you can see, the blue one is falling and rising a lot more. So in this case, the blue line represents an asset with a higher volatility, and the green line represents an asset with lower volatility. So if we try to sort of formalize some of these definitions in terms of calculation, we can then go on to talk about how volatility is used in options. So just to summarize, the standard deviation of the daily returns of the underlying asset is used to calculate this value called the historical volatility. And then we annualize that, and we represent that with generally a number, say 30 or 10, something like that. That will show us how many percent we expect the asset to move over the entire next year. So for equity markets, generally we don't trade 365 days a year. So weekends are off, then there's holidays. So in total, that comes up to about 252 days. So in order to annualize the historical volatility, we generally multiply it by the square root of 252. So this value is also generally calculated on a rolling basis. So this is because as a snapshot, it doesn't give as much value, but when we calculate it on a rolling basis, we can get something much more useful. So if you look at the image on the right, this is showing us the S&P 500, micro S&P 500 index futures actually. And then at the bottom, you can see the historical volatility over the past 10 days. So now the value over here that we see, 6.78, that's the historical volatility over the 10 days prior to the 1st of July. So within this 10-day period, the historical volatility is calculated at 6.78 on an annualized basis. So if we calculate it on every single day, and then we look back to the 10 prior days, we'll get this sort of line at the bottom, right? And that can show us how the volatility shifts over time. So generally, when we're talking about historical volatility, we'll calculate it on a rolling basis. And then we'll also often refer to it as a realized volatility. So in contrast, how do we turn this into options, right? So options, as we mentioned, they have a lot to do with volatility. It's fundamentally why options exist. So that's why volatility is kind of key in understanding how options work and how they're priced. So while the historical volatility, we were looking at the past, right? We were looking at what's already happened in the past 10 days in this example. When we're talking about the implied volatility, which is what's important when we're considering futures, that's when we want to look at what the expected future volatility of the asset will be. So this is what we expect the volatility starting today would be, say, 30 days from now. So over the next 30 days, how volatile would an asset be? Now again, nobody can predict the future as much as we would like to. So generally, this value generally comes down to something that we imply from an options price. So we can go into a little bit of detail around that over here. So as I mentioned, IV is the expected future volatility of the asset's return. So it's inferred from the market price of the option. Since we don't know what's going to happen in the future, what we do is we take the inputs we're given. So in this case, the options price, it can be used to back calculate the implied volatility of the option. So the expected volatility is generally an input into the theoretical pricing of a option. So once the prices what we're looking at in the marketplace are already given to us, we can essentially use them to back calculate the implied volatility, or the volatility that's being implied by options markets according to what the current prices of those options are. So what you see on the right, this is a chart that shows the contrast, that shows the difference between the historical volatility and the implied volatility. So in the previous chart, the blue line that you saw, that was the historical volatility. In this case, this is over 30 days. So what we've contrasted that with is the implied volatility 30 days ago. So 30 days ago, what did options markets tell us that the volatility would be today? So that's essentially what this chart is showing us. And what we might notice just off the bat, right? For most of this period, the implied volatility is much higher than the historical volatility. So that's generally a trend that you would observe across markets. And it's not just in particular based on this example, right? This is something that you would generally see. And the reason behind that is that the implied volatility is not an exact value, right? This is something we're approximating in some way. So since we can't tell the future, there is uncertainty associated with this. And that uncertainty is expressed in the form of a premium. So that premium is essentially why the implied volatility is generally going to run higher than the actual realized volatility of the asset. So with some of that context behind volatility itself, we can move on to options pricing. But before we do, maybe I can open up the floor for a minute to check if there's any questions.
As of now, no questions. You can proceed.
Okay, sure. So moving on, right? Now that we have some context on volatility and implied volatility particularly, we can move on to how options are priced. So first of all, when we're talking about options pricing, we can theoretically calculate what the ideal price of an option should be. So this is the theoretical value of an option. So in order to calculate this, we'll need 5 things. The current underlying price, so that would essentially be the S&P 500's price today. So where it is today, that's the current underlying price. The strike price, time to expiry, both of these 3 already walked you through, right? So the strike price is the level at which the option would be exercised, and the time to expiry would be the number of days left until the option's expiry date. Finally, the implied volatility concept that we just walked through. So in essence, if I was just to simplify this, right, implied volatility in this case is an input to this formula, but it can be sort of calculated using more sophisticated market models based on how maybe markets were performing previously. But now that we're not getting into that much detail, I'll kind of just let you know that that's one of the inputs that will go into the theoretical price of an option. Finally, what we'll need is the risk-free rate. So since market makers are going to be selling the option, they would want some sort of return on their sort of sale, right? And they'll generally want to aim for something that's at least higher than the risk-free rate. So typically, if they can, get the risk-free rate, why would they go for anything lower than that, right? So typically, this risk-free rate is assumed to be the 10-year US Treasury rate. So given all of these 5 values, we can plug all of them into a theoretical model, a couple of theoretical models actually. So the first one, it's the Black-Scholes formula. So this was pioneered in 1973, and it's one of the most famous formulas in financial mathematics, right? So this is something that can be used to theoretically price what the ideal price for a European option should be. Now, we won't be going into detail on how the formula actually works, generally because that would be quite heavy in terms of mathematics, and the price is also generally shifting. So it's a very dynamic calculation in that way. The second way that we can calculate an options price theoretically is using something called a binomial method. So for the European option, the theoretical calculation is somewhat easier because there's only one expiry date, right? But for American options, since we can exercise it anytime before expiry, we have to take that into consideration. So all of these inputs are essentially being used to come up with a probability in some way that the option would expire in the money. So if that probability is high, you would generally charge a higher premium for that option, and consequently you would price that option at a higher premium, right? And subsequently, if the probability that the option will expire worthless is high, the price of that option should likely be low as well. So the way that we can calculate it is using these two methods. So for American options, that's the binomial method. So that's generally on a discrete time basis. The option can move up and down. And that's used to calculate the probability that the final exercise point will be in the money or not, what the probability of that will be. And that can help us arrive at the sort of theoretical value. Now, the good thing about, especially about micro E-mini options, right? They're extremely liquid. So this is something that we covered in the previous presentation, but they're a highly liquid asset class. So market makers are very active on these options. As a result, the prices that you would see in the market for these options, they're generally very close to these theoretical values. So that's one of the reasons that we don't necessarily need to understand, or maybe we do need to understand, but we don't need to calculate the theoretical price ourselves in this case. So one of the ways that we can do that is using the CME calculator. So that will just allow us to input the characteristics of the option, and then that will calculate the price of that option for us. So this is a very valuable tool, and it's available in CME Quickstrike. So CME Quickstrike, for in case you guys don't know, it's a platform. It's freely available, made available to any CME free account holder, and it allows you to access a lot of useful tools like this. I mean, if we do kind of want to go into that later, maybe we can discuss that. But in brief, lots of uses, and it's a very powerful tool. In particular, on this page, what you're seeing is the calculator. So within this, we've just entered all of those inputs I mentioned, right? The strike price of the option, the type of the option, so whether it's a call or a put, the underlying price, in this case, the futures price of S&P 500, the number of days to expiry. So this is the option that we're considering is one that's expiring on the 26th of July. So 3 days from now. And then the risk-free rate right now, 5.5%. Yeah, so that's essentially letting us plug all of these values into this calculator, and it's going to give us the theoretical calculation out here, right? So the price, as we can see, would be $38. So this option, strike price of 5,600, given a underlying price of 55.98 today, and expiry just 3 days from now, it would only cost us $38 in premium, right? Now, what we can also see here is a relationship between the price and the implied volatility. So this is something I mentioned, right? All else being equal, the price of the option is directly proportional to the implied volatility of the option. So as you can see, the two theoretical prices that we have calculated here, one was the one that assumed the volatility that is currently sort of observed on CME option. So that we can take as 18. So given the implied volatility of 18, we come up with a price of $38. But say if we reduce that price to $27, we can see consequently the implied volatility is also falling. So essentially, they're directly proportional. An option that's more expensive will have a higher implied volatility, and an option that's cheaper will have a lower implied volatility. As you can see, we've already done a couple of these calculations. So those are the ones provided below. Another, very useful part about Quickstrike is the pricing sheet. So we don't need to be we don't need to be revisiting that options calculator, entering all of the different strike prices we might want to consider, and doing that each time, right? So the pricing sheet allows us to automatically generate all of that data for a range of strike prices. So what you see here is the pricing sheet for E-mini, micro E-mini S&P 500 options. And the yellow bar that you see here, that's the current underlying price. And as you can see, it's showing us 10 strikes above and 10 strikes below that. So within those strike values, what is the premium required for those options? And this is telling us what the markets are telling us right now, right? What the quotes are. And then what we can also see is the settlement price. So this is what the options settled to yesterday. And then the column is telling us what the current price is being quoted as in the market. So this is just going to allow us to generate this for a range of strike levels, and particularly useful because we can change the number of strike levels. And then what we can also do is observe this in the form of calls and puts exclusively, if that's something that is required for the particular option strategy. So
Pranay?
with that, yeah, Sri.
Yeah, there are a few questions. Maybe
Sure.
try and have a stab at those, right? Ian is
Yeah.
asking, can we view calls behave like rental contracts while puts behave more like insurance contracts?
Right. In some ways, you could say that. But in general, the options, especially when we're talking about strike levels close to the underlying, they'll generally behave in similar ways. So although the application behind the option might be as you described them, they would not necessarily, in terms of price, behave like that. So if I was to simplify that, although the purpose behind that might be insurance, although the purpose behind opening a put position in many cases might be insurance, that's not necessarily how the option will behave in the market. Especially if an asset price is declining too fast, it won't just be an insurance contract anymore, right? People will be using that put option also to express their view on the underlying asset price declining.
Sure. Thanks,
Uh,
Pranay. Another question. This is from, sorry, Pranay, you were about to say?
no, I was just asking if that was clear.
Okay. I think so. I think you clarified. I also responded on the chat as well. The next question is from Sean. So is
Mhm.
volatility the priciest component of option pricing, or does it depend on whether the strikes are in the money, at the money, or out of the money?
Right. The implied volatility, as we mentioned, is just one of the inputs into the options formula. Perhaps the most important thing would be the moneyness of the options, because as she described, there can be an intrinsic value behind the option, right? So if we're talking about an in the money option, that's an option that has an intrinsic value. So if we're talking about an American option and we decided to exercise that today, the payoff that we could receive, that would have actual intrinsic value. So we could just at the moment exercise that and sort of lock in our profits, walk away with that, right? So in that way, the moneyness might impact the overall options price a lot more. But given that all of the other inputs for an options price, the strike, the underlying price, the expiry, the risk-free rate, all of these things are always known to us, right? What's perhaps unknown is the implied volatility. So it may not be the most impactful in terms of its impact on the price, but it's very useful in terms of understanding how markets are pricing, how sort of prices are behaving on options market rather. So that's one of the guides, because the rest of the inputs at any point they're always known. Implied volatility is sort of the only uncertain aspect here.
Thanks, Pranay. If I may just add to that as well, Sean, typically in the money options are more expensive than out of the money options, which is why typically when you see trades happen, liquidity typically is centered around out of the money options. So, Pranay, one more question, the final one for now, is from Ian. His question is, how does IV behave over time, especially towards expiry?
Right. There's a few factors that can generally describe that. So one of the reasons I won't go into too many details about this is because when we're talking about this, we might have to start discussing options Greek, and that could just run this seminar, another couple of hours longer. So I won't go into too much detail here. But generally, an implied volatility could generally increase or decrease close to expiry. But when we're approaching expiry, as the option has less probability of expiring in the money just off of random movements, the price of the option is generally going to be lower, and subsequently the implied volatility will also be lower as we approach expiry. But also something crucial to note here is that the implied volatility behavior is heavily impacted by events. So earnings, for example, as we mentioned, right? Around earnings, implied volatility can spike sharply. And similarly around risk events such as FOMC meetings. So those can perhaps be more of the defining factors behind what's driving implied volatility rather than expiry.
Thanks, Pranay. Those are the questions for now. You could proceed. Thanks.
Right. So with some of that context, right, and knowing where we can find the options prices, maybe we can go into a few hypothetical trading strategies. So starting with an overview of some of the most common ones, right? So all of the different strategies that you see on the page here, they're all strategies that consist of more than one leg. So that's a combination of multiple options within this position. So there's generally one or two. In this case, all of these, have multiple legs associated with them. Particularly today, we'll be covering bear put spreads and bull call spreads. But we'll maybe start with something simpler, right? A long call. So this is something that Sri already walked you through somewhat previously. So I can maybe be a little more quick about this so we can focus on the more sort of complicated scenarios a little later on. So in particular, as she mentioned, long calls are something that we would use when we want to express a bullish view on the underlying. And at the same time, we want to limit the downside. So we don't want infinite losses, but at the same time, we want to gain in case prices rise. So a hypothetical example that we're considering here is to buy a call option at a strike price of 5,700. And if you look down here, we're assuming in this hypothetical example that the underlying price for that option is for the futures the options are based on is trading at 5,500. So that's not where the S&P is. So this is a hypothetical example. So given that the S&P is currently at 5,500, we buy a call option at 5,700. What does this give us? This gives us, in theory, a maximum profit for this trade that's potentially uncapped. So this profit could be theoretically infinite. Practically, it might be capped, since there's not infinite money, but theoretically it can be unlimited. And at the same time, it's giving us a maximum loss that's limited to the premium paid upfront. Another important calculation is the break-even point. So this is something Sri mentioned, right? This would be when our net debit is equal to our net credit. So essentially, this can be calculated in a very simple way based on the strike price plus the premium. So the premium that we're paying in this hypothetical example is 25 index points. So just to clarify here, each micro E-mini S&P 500 option provides exposure to 5x the index value. So while the index premium is 25, the premium in dollar terms that we would pay would be $125 because essentially we're getting exposure to 5x the S&P 500 index. And because of that, a simple way to calculate that break-even point would just be to add the premium paid in index levels to the strike price. So that is something we can calculate, and that comes up with 5725. And just for completeness sake, we're just assuming that this option expires on the 23rd of July. So given all of these inputs, we can look at certain levels and based on the calculations, what the payoff will be. So just to contrast really quick, at 5,500, the payoff from our futures position might start going up beyond this. I think the columns here are somewhat reversed. So the top one should actually be futures and the bottom one would be the call option. So as you can see with the futures position, the one at the top, as prices rise past 5,500, the current price, the payoff from that position is just going to keep rising. So if we go to 5,700, it's going to potentially pay us $1,000 in profit. Contrastingly, the options position, so the one at the bottom, that would not pay us anything until that strike price, right? So until that strike level, that option is entirely worthless. So our net sort of profit or net loss from this trade is minus 125, which is the premium we paid upfront. Now at 5725, our payoff is going to be $25 times 5, so 125 in terms of what the option's intrinsic value becomes at expiry. And from that, we can subtract the premium we paid up front, 125, and that gives us the break-even point. So as you can see, the options position, while it only breaks even at 0, its real value is perhaps if we step backwards, right? So if we go all the way back to 5,000. So if the prices fall all the way down to 5,000, the maximum loss from a futures position, would be drastic. It would be minus $2,000, right? But for an options position, regardless of how far back we're going, that payoff is that loss is always going to be limited to $125. So while this sort of offset that you're seeing is the difference between the premium paid as well as the difference in the strike level to the current level. So 200 times 5, 1,000 plus the premium that we paid upfront, 125. So that's essentially what you'll observe here is the difference in the payoff for futures and call option in this case. So while that payoff profit in case prices rise is somewhat limited, the losses are where the long call position is kind of shining, right? Similarly, we can move on to a long put, right? So this very similar again to what Sri has already run through. So I won't focus on this too much. Just describing the characteristics of the option. So the option is we essentially buy a put option 5,300 to express the view that the S&P 500 is going to be falling. And at the same time, we want to limit the downside for this position. So in theory, the maximum profit for this trade would be limited since the S&P 500 cannot trade, below zero. So this theoretical limit would be around $26,000. But again, that is purely theoretical. The maximum loss for this position, again, similar to the long call, it's limited to the premium we pay up front. So beyond that, our losses are capped. So we're not going to lose any more money beyond that. So similar inputs, right? We're assuming the premium is going to be $25, and in US dollar terms, that comes up to 125. The break-even point in this case would be the strike price minus the premium. So since this is only going to work when prices decline, so that comes up to 5275. And if we, again, sort of see the payoff, right? Similarly, you might notice on this table, the futures are at the top, options position is at the bottom. So at the top, the futures payoff that you see, prices start declining from 5,500, we start to make money from the futures position. But if the prices rise to say 5,900, all of a sudden we're in a loss of $2,000, right? Contrastingly, from the options position, the one at the bottom here, we would only lose $125. So similarly, the difference between these strike level and the underlying level was 200, and the premium was the same. So the difference you'll see in these values is going to be the same as well. So 1,125 is going to be the offset in terms of profit, but at the same time, that's helping us cap our downside, right? Now, I think that was just in brief, right? So maybe we can move on to slightly more complicated scenarios here. So in this case, a bull call spread. So a bull call spread consists of two call options, one that we're selling and one that we're buying. So in this case, the position offers us fixed upside as well as fixed downside. And more importantly, it lowers the premium requirement. So the premium requirement for a long call, as we saw previously in the hypothetical example, was $125. In this case, if you'll see at the bottom, the premium we actually pay down here is only going to be $50. That's because while we'll pay the premium for the long call, we'll also make money by selling a short call. So that will essentially be an upfront premium that will be paid to us, and that will help offset the upfront premium that we'll have to pay as we buy the option. So in this case, the scenario assumes that we're buying a call option at a strike level of 5,600 and we're selling it at 5,700. So the maximum profit from this trade is going to be limited to the payoff from the long call option at 5,700 minus the net premium paid. So in this case, $50. And the maximum loss for this trade is always just going to be that, the upfront premium that we paid, similar to the previous position. So it's always just going to be limited to $50. So if we calculate the break-even point again, that's going to give us the strike price for the long call plus the net premium paid. So when we're talking about index terms, we can use the index premium value to come up with these break-even points quite simplistically, right? We don't have to multiply anymore. We can just add them directly. So the net premium paid plus the long call, the strike price for the long call rather, that will give us the break-even point for this position. So as you'll see, while if we try to sort of walk through this position a little bit, right? So this is a combination of two positions. We're long a call option at 5,600. So as we go past 5,600, you'll see the orange line starts to rise. So that's the long call making money. But at the same time, you'll see we're short call at 5,700. So past 5,700, that option, short options position is going to lead us to a loss. So that's going to start declining from that point forward. And from any point beyond 5,700, those profits from the long call position are going to be equally offset by losses from the short call position. So essentially beyond this level, all the profits here are going to be offset by all of the losses here, and our payoff is going to be flat from that point onward. So our payoff would essentially be limited between the levels of 5,600 to 5,700. So those are our two strike levels, right? The strike for long call, the strike for long put. More importantly, perhaps, the premium that we pay and our maximum loss in this case limited to just $50 because some of our premium is being credited in the form of that short call position. As you can see, the maximum sort of profit from this position can be calculated at $450. So that's going to be the payoff from the long call at 5,600. That's going to be the payoff in terms of a $100 position. So $500 minus the premium paid, $125. That gives us $375. And at the same time, we're getting a net credit because that short call at 5,700 is just going to expire worthless. So that's also a net credit we'll gain. That'll come up to $450. So beyond that point, as I mentioned, all of the profits from here will be offset equally by losses from the short call position. So it's just going to stay at 450 from that point onwards. So this was the bull call spread. Similarly, we can execute something called a bear put spread. So this is similar, just that we're going to be using two put options. So we're going to be going long a put option at a higher strike price, and then we'll be going short or selling a put option at the lower strike price. So some of the calculations here will be somewhat similar. So our maximum profit here will be limited to the payoff from the long put at the lower strike level. So what are buying the put option at 5,400? How much profit would that mean at 5,300? It would be $500 minus the premium that we pay, $125. So it would essentially be $375 again, right? Same as the previous example. So that would be our payout at that level. And then from that, we have to subtract the net premium that we pay. So the premium that we pay minus the premium that we earn. So the calculations are similar in this way, so I won't run through them again. What I'll just highlight is the fact that in the same way as the bull call spread, the bear put spread, the long puts profits beyond this lower strike level are being completely offset by losses from the short put position. So in the same way as the previous example, as we move past 5,300, so rather below 5,300, as we keep going lower and lower, while the long put position is going to make a lot of money there, it's going to be offset equally by the short put position. And you can see some of those calculations in a similar way done here. And again, what I'll highlight here is the fact that our premium paid for this position, first of all, is much lower than a straightforward long put position. And more importantly, it's capped. So it's just going to be always limited to minus $50. While the short futures position might lead to a loss of $2,000 at 5,900, the bear put spread, that's just going to lead to a loss of $50. So it's essentially, in some ways, very fixed downside, right? The only difference I would highlight is the break-even point in this case. So the break-even point is calculated slightly differently. It's the strike price for the long put, so the higher strike level in this case, minus the net premium paid in index points. So that's 25 and 15 because those are 5x values. So that's going to give us 10. So the strike price for the long put was 5,400 minus the net credit, minus the net premium, which is 10. So that gives us the break-even point of 5,390. So with that, maybe I'll pause for a minute here and also kind of transition over to Sri from this point for the final section.
Thanks, Pranay. Pranay, as of now, no questions from the audience. If there's anything, please type in before we move to the final section of this webinar. Okay. Pranay, are my slides visible now?
Yes, they are.
Okay, thank you. All right, so we'll continue. Happy to take on questions if any. Feel free to type them in. This is the final bit. So we did highlight that there are idiosyncratic risks to trading options. Trading is beset with risk. Investment is beset with risk. Essentially, no risk, no return. So in fact, I was making a presentation in Dubai not too long ago. Elderly gentleman, this was in commodities, an elderly gentleman came in and he must be in his late 60s. He said, Mr. Sri, the greatest risk in life, particularly in business, is to not take any risk at all. So not taking a risk is in itself the largest risk, perhaps. So the reality of life is that whatever the endeavor may be, there are risks. What is required upon the party who is taking on that venture is to figure out how to manage that risk. And that starts with knowing what are the risks that one is exposed to. Specific to trading, multiple risks. Specific to option trading, these are the two idiosyncratic ones. One is gamma squeeze. What is it? It is when you expect the price to not move and prices start to move, and that results in magnifying losses on the portfolio. So that's gamma squeeze. You would have seen this in newspapers time and again. If you Google this term, you will find so many cases. In fact, a lot of times, stock prices, commodity prices, they move because participants are gamma squeezed. And in the process of trying to hedge, they move prices in a way that makes it even more worse for them. Which is why when trading options, when shorting options, which results in gamma squeeze, one has to be very, very, very careful. I cannot overemphasize this. This perhaps is the largest risk for any options trader, practically the greatest nightmare, if you will. The next dimension of risk in options trading is theta decay. What is this? So this is when you expect the price to move. So going back to my NVIDIA example, right? You bought the option when NVIDIA shares was 400, your strike price was 600. You expected NVIDIA to go up to $1,000, but the thing didn't move. It just stood at $410. So all the premium that you have paid for a 600 call will essentially expire worthless if NVIDIA share prices remains below $600. So in this case, your expectation of life is that share prices should move or the underlying index price should move, but it doesn't. So that results in the premium expiring worthless. That's theta decay. Again, can you neutralize these risks? Somewhat, yes, but 100% risk elimination is not possible. If you did that, essentially there'll be no upside event, right? So you will be exposed to some risk. So that's where genuine alpha comes in. As an analyst, as a trader, you got to know what exactly is going to happen. And this is a mere instrument in being able to realize that expectation. If your anticipation is correct, if your views are correct, you will stand to gain. If your views were wrong, if the future turns out to be different from what you anticipated it to be, then you will lose money. So, and when you lose money, how do you minimize the loss? That's where options can help. So with that backdrop, let me move on to this, right? So these are rules of thumb, risk management considerations, right? So I have personally traded options for many, many years. I've seen our clients trade this for many, many years. I'll be candid to say I've lost money. I've learned a lot of expensive lessons. I've also made a lot of money as well. So that's on the upside as well. So very crucial, even for experienced traders, out of 10 times, if you're successful, if your views are correct 5 to 6 times, you're already an exceptional trader. Even the best ones, even the greatest ones, their hit rate is 50 to 60%. What is crucial is that when you're wrong, you don't get blown away. You survive to fight another day. And when you're right, you got to maximize the profit from the trade. That's what institutional traders or good traders do. Minimize the loss, maximize the profits. Most retail investors do the exact reverse. So one starts as a trader. When they start seeing losses on their book, they keep on holding on to it, praying to every god possible, hoping that the prices will make a turn. Typically, it doesn't. So a trader becomes a long-term investor holding on to loss-making shares. When they see profits, they get greedy. They take profits very quickly. They hold on to losses for too long. They should be doing the reverse. Cut losses quickly, almost emotionlessly, right? You should just cut losses quickly and hold on to profits for as long as you can, as long as it makes sense. So essentially, if those two elements can be, if you can get control over those two elements, essentially you will be a successful investor and a trader. But I would like to start this section of the webinar, and I'm cognizant of the time as well. We are slightly past the time. We should be able to wrap it up soon. Is this concept of Dunning-Kruger effect? It's a concept from psychology. So the Dunning-Kruger effect says this, right? So this is kind of visualized in this chart. So what is the y-axis shows the conviction, the x-axis is the knowledge. For most people, this is across all fields, from music to investing to think of racing or golf or whatever, right? When someone gets to know, learns a little, so they think they've known it all. They know that they get to have this conviction that they know everything that is required to be known and they can master and ace the domain. So this is where financial traders are no different. So once you cross the child's hill, if you will, that's when the fall comes. When for the first, let's say it's 60 days of trading, right? You're very, very careful. You're very cautious. You start to make some money. Then by the 60th day, you typically think, now I know it all. Now I can go big and I can make it really big in life. And that's when losses start ballooning. And that's when the fall comes about, right? It's a substantial fall. And that's when one realizes, oh, there is a lot more to be known than what I already know. So that's when conviction falls, because the realization of what is to be learned then dawns upon the person. And that's when one starts to realize that and starts learning and starts improving and has the discipline to apply what they know. Then you create the growing up mountain, if you will, right? So this happens to option traders all the time. In fact, there is research to point that most retail investors lose 90% of their capital 90 days, essentially. And how is the fastest way of losing money? Options. And what causes it? It's gamma squeeze. In fact, we deal with a lot of expert traders as well, right? So in fact, we were having a conversation just late last week. So this guy has been trading commodity futures for almost 5 years. Asked him, do you trade options? He says no. His firm, in fact, prohibits them from trading options. Why? Because options has asymmetric payoff, as Pranay explained in his illustrations. For a small amount of pain, you can have substantial gain. But if you're on the wrong side of it, for a small amount of gain, your pain can be outsized. So which is where most futures traders even stay clear of options. So this requires knowledge. As much as this is the fastest way to lose money, this is also a great way of making money. In fact, some of the richest investors know how to use options to their benefit. So the question eventually boils down to, do you understand this instrument or not? That's number one. Number two, do you have the discipline to apply what you have learned and to continue to stay disciplined? If you can do those two, job done. Frankly, in fact, as what we typically tell our audience, right? Trading is not difficult. Trading, actually, the concepts are easy. What makes it hard is having the discipline. The mental forces of greed and fear can even trip even the greatest of experts, right? And that is where they typically know where their boundaries lie. 90% of the options expire worthless. So this is the theta decay that I was talking about, right? So if you know how to sell options and be in that 90% domain, then you'll be successful, right? So think of Warren Buffett. He runs an insurance company. Bulk of his Berkshire Hathaway business is insurance company. And what do insurance companies do? They keep collecting premiums all the time, and they know how to manage their risks, right? And if you do it successfully, you will be a rich investor. And that's who he is today, right? One among the richest in the world. Being in the 10% is not easy. Easy said than done. You can read all the books. As I always typically say, right? Options trading is a bit like swimming. You can read 10 books on swimming, but it's never like being in the water. Once you're in the water, all that you've read in the books is out of the window, right? How do you manage it when in the moment, when losses are hitting in your face? So that's what separates a good one from a bad trader. Falling prey to gamma squeeze is very high, which is where we strongly advocate not having any naked shorts. Selling a short call, selling a call, or selling a put naked without having the hedge around it is very, very, very dangerous. And your clearing broker will tell you, right? So typically the margins are very, very high, and typically they discourage you from having naked shorts. Because gamma squeeze, if you're not a trader watching your screens all the time, better still, if you're not a trader who doesn't have a program to help you hedge, automated algo programs, then you typically shouldn't be shorting options at all, right? So generally what we have noticed as common risk mitigated options trading strategies are covered calls. You have the asset and you collect dividends, but you're not happy with it. You want to have additional yield on the asset. Sure enough, you can then sell a covered call. What is a covered call? You have the asset and then you sell the call on top of it. If the prices rise, your asset goes up in value, then you sell the asset to the buyer of the call option. You don't have that much risk there. What is the risk? The risk there is the value of the asset itself drops. That is the risk that you face, in which case the options expire worthless. That premium is for you to keep. Generally a safe strategy, especially for those products that do not pay dividends. This is a wonderful strategy. This is a clever way of generating yield on non-yielding products. So that's a covered call, typically safe. Vertical spreads, the ones that Pranay explained in his examples, the two spread examples, are also typically good in that you can engineer a trade which gives you a much higher reward compared to risk. So your risk, let's say the example that he had was $50 on the downside, maybe $450 on the upside. That's a 9:1, risk reward to risk ratio. In fact, we used to advise a client in Italy. So he has been trading commodity options for a long time. So his philosophy is simple. He will never get into a trade unless it has a 4:1 reward to risk ratio. Meaning, for 1 unit of risk, if he's risking $1, he must have the potential to make $4. If he doesn't get into the trade at all. When you sell options, you typically do the reverse. For 1 unit of risk, 1 unit of return, you're typically exposed to 4 units of risk. Meaning, I can make $1, but I can potentially lose $4. That's a no-no trade for him, a complete no. And he has a discipline to stick to that, which is why over the last more than 20 years, he has amassed substantial wealth. It is possible, right? But having the discipline is not easy. Easy to understand, hard to apply. Finally, butterfly and iron condors. So today's session with 1 hour, it's hard to cover all these different strategies. Here again, your downside risks are mitigated. So these strategies, again, typically tend to be risk mitigated. Again, as you may notice, right, the word that I'm using is mitigated, not risk eliminated. Again, as a general rule of thumb, if anyone tells you this is a risk-free investment opportunity or a product, that's a straight red flag, right? No risk, no return. So if someone is trying to sell that to you, you got to worry as to what is in there, right? Too good to be true, essentially. So with that, I'll bring this webinar to a conclusion. Shri, I'd like to know if there are any questions from the audience at this juncture.
We have two questions. One is from Ian. Ian is asking, is it possible that at the money options have strike prices higher than underlying?
Thanks, Shri. So, Ian, thanks for the question. Again, I think that, as I mentioned earlier, right? So, what makes at the money is the strike and the underlying. The difference between the two defines whether the option is in the money, out of the money, or at the money. By that question, I think perhaps I've not been clear enough. If the strike price and the underlying are at the same level, so it makes it at the money, right? So, if that being the case, it wouldn't be possible for the strike price to be higher than the underlying then. Hope I've clarified.
Okay, one more from Wee Xiang. Wee Xiang is asking, can he have the recorded video? Yes, you can, Wee Xiang. We'll send a link to the recorded webinar in our follow-up email, or you can look for Philip Nova Facebook. Look for Philip Nova Facebook or the YouTube channel. A live recording of this session will be uploaded. You can look for the video on these two platforms directly after this webinar, if should you wish to do so. All right, so those are the two questions that we have. Thank you so much to our speakers
Shri,
for,
sorry,
yeah.
Shri. Well, there's one more question I think from Ian. Is it not safer just to buy calls in uptrend and buy puts in downtrend? The short answer is yes. Catching the trend,
Mm.
if you're able to catch the trend, cleverly, Ian, that's it makes sense with what you're saying, provided the volatilities are not too high. In a uptrending market, if volatilities are very high, then the premium that you pay could maybe far more than the upside that you can get from the underlying move. So that is something to keep in mind. Hope you're clarified there.
Okay, Sri, do you want to take one more from Daniel? Daniel is
Yeah,
asking if we can do
Daniel.
a
Yeah.
vertical bull put spread. What vertical spread can we do with call options?
What vertical? Pranay, you want to address that?
Right. So we showed two examples, Daniel, today. One was a bull call spread. So that consisted of two call options. Alternatively, the other one we did was a bear put spread. So that consisted of the two put options. You can also do, there is something called a bull put spread as well. But essentially, that's something that you would execute using two put options in a rising market. But different from the examples that we discussed today.
Okay, all right. Thank you so much to our wonderful speakers, Srinidhi and Pranay, for giving us a deep dive into options trading and the various strategies and risk management strategies that you can employ. All right, very quickly before we close the session, Philip Nova is offering options trading at only 50 cents. For those of you who are keen to trade the S&P 500 options or the Nasdaq 100 options, you can do so at just 50 cents. All right. Let me just flip my screen. Okay, and the other thing I wanted to share is if you want to learn more about options trading, you can do so in our upcoming webinar. If whatever we've shared with you in the last two sessions, including today, if that's not enough for you, want more options, yes, we have one coming out on 13 August. Do sign up for it. And ensure that you have all your questions addressed before you start trading your options. All right, so that's all the time that we have for today. If you have any other questions, you can send them in the survey form, and let us know if there's any other help you need, or if you'd like us to walk through the platform so you can understand how you can trade options better using the platform. All right, and that's all the time that we have. Have a wonderful night, and thank you for the wonderful, wonderful questions. We were thoroughly engaged, and I believe our speakers were as well. And a big thank you to our speakers for walking through options trading today.
Thanks, Shri. Thanks, everyone.
Okay,
Thanks,
that's
guys.
all the time that we have. Take care, good night, and all the best we are trading for the rest of the week.